For decades, building premium wealth required one specific thing: hoarding massive amounts of capital. That barrier is gone. Historically, the path was rigid. You had to aggressively save $50,000 for a real estate down payment or scrape together enough cash to buy whole shares of expensive blue-chip stocks. That system locked out the average retail investor. The primary consequence was lost time. While you spent years stuck in the saving phase, you missed out on decades at some compound interest. Today, you no longer need a massive pile of cash to get started. But the true cost of entry hasn't disappeared. It has shifted from capital to compromise. We now operate in a fractional ecosystem. You can buy $10 slices of premium assets instantly from your phone. This chart shows investment effort versus capital required. Traditional real estate and angel investing demand maximum capital and effort, but modern retail investors operate down here. Fractional stocks, REITs, and fractional property cluster in the most accessible corner: low capital, low effort. However, this instant market access hides complex, diverging trade-offs. Each of these assets handles your liquidity, your taxes, and your control very differently. Picking the wrong fractional vehicle for your specific tax bracket and timeline will silently erode your returns over time. Let's evaluate the options. Path 1 is buying fractional shares of major companies like Amazon, using platforms such as First Trade, eToro, or Interactive Brokers. The upside is clear: commission-free exposure to premium equities for under $10. They also allow for automatic DRIP. A DRIP, or dividend reinvestment plan, is a program that automatically uses your cash dividends to buy more fractional shares of that exact stock. But here is the hidden trade-off. Those fractional shares are largely non-transferable. You are rigidly locked inside a single financial institution. If you ever want to switch brokers, you cannot simply transfer a fraction of an asset. You are forced to liquidate it entirely. That forced liquidation triggers an immediate taxable event, making you pay capital gains taxes before you actually plan to. Fractional stocks offer ultimate budget access, but they effectively trap your equity inside a closed platform ecosystem. Path 2 involves REITs. A real estate investment trust is a company that pools investor money to buy and manage portfolios of real estate. These trusts trade exactly like standard public equities. You buy and sell them on the stock market, which provides instant, effortless liquidity. The primary appeal is income. By law, a REIT must pay out at least 90% of its taxable income directly to shareholders as dividends. But there are two traps here. First, because they trade on public exchanges, REIT values often crash during broader stock market panics. This breaks the illusion that you hold a safe haven asset decoupled from Wall Street. The second trap is the tax drag. Those high REIT dividends are taxed at your higher ordinary income rate, rather than the lower capital gains rate. REITs give you real estate exposure with effortless liquidity, but they heavily penalize your tax efficiency if held in the wrong type of account. It is also vital to understand that REITs are rarely buying suburban homes. They purchase massive commercial infrastructure that individual investors could never access on their own. This includes retail commercial real estate portfolios that dominate high-traffic urban centers. It covers digital infrastructure, like the tech-focused real estate of server farms and data centers. They purchase massive industrial supply chain facilities and sprawling global logistics warehouses. And they own major healthcare facilities as well as broad social infrastructure. Buying a REIT is a macroeconomic play on global infrastructure. It is not a localized property investment. Path 3 is fractional real estate. Platforms like Lofty or Fundrise allow you to buy a $50 legal stake in one specific property. The main upside is true physical asset correlation. Your money is completely decoupled from Wall Street panics and algorithm-driven stock market crashes. You earn daily or monthly rental income directly from the actual tenants living in or using that specific building. You take on concentrated risk, where one single burst pipe in a basement directly destroys your monthly yield. There is also a secondary liquidity risk. Selling your shares depends entirely on the platform's internal secondary market having a willing buyer. You cannot dump it on a global stock exchange. Fractional real estate provides true property correlation, but it demands that you sacrifice the instant liquidity of the public markets. This chart shows a comparison matrix of how these three vehicles stack up against each other. Fractional stocks offer high liquidity, are taxed as capital gains, but remain heavily correlated to the broader stock market. REITs also offer high liquidity and stock market correlation, but their dividends are taxed as ordinary income. Fractional real estate features platform-dependent liquidity, generates localized rental income, and correlates only to the physical property market. There is no perfect universal asset. There is only the asset that correctly fits your specific personal constraints. This chart shows a final decision framework based on 3 distinct profiles for the modern retail investor. If you are a budget-conscious beginner prioritizing long-term growth, use First Trade or eToro for fractional stocks and accept the broker lock-in. If you are time-poor and want passive income, buy broad REIT ETFs. An ETF is a pooled investment security that holds multiple underlying assets. However, you must hold these inside a tax-advantaged account, like a Roth IRA, which is an individual retirement account offering tax-free growth, to shield that income from the tax drag. If you want direct property correlation without taking on a mortgage, use fractional real estate platforms. You gain control, but you accept active research and lower liquidity. The tools to build premium wealth are finally available to everyone, provided you apply the right tool to your strategy. The capital barrier is gone. Your only job today is aligning tax and liquidity trade-offs with your actual financial reality.